From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro. A bit of a bid to markets finally after getting some positive news, at least from the bulls on the street from the Treasury Department. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures wavering after closing out the worst October in 3 years. The Treasury announcing plans to boost refunding by less than expected $9 billion, and investors bracing for Chair Powell and another Fed rate decision. We begin with the big issue. Goodbye, October. Hello, November.
The market's been weak.
Equity weakness.
Rising bond yields.
Fixed income volatility in general has been off the charts.
Stocks are in a bit more of a wait-and-see mode.
Investors are looking for any glimmer of hope to start a end-of-year rally.
You've got an opportunity, if events don't erupt in the Middle East, for year-end rally.
This economy will come off the boil.
The big thing is, what's inflation doing, what's economic growth doing, and what's the Fed doing?
No one's expecting the Fed to hike rates this week. The Fed is going to hold.
Whether they actually hike rates again is a question mark.
The market will be more focused on Apple.
We'll get employment this Friday.
The jobs number, is going to be incredibly important.
The labor market is the key right now.
Everybody's trying to figure out what the underlying trend in the labor market is.
Join the confusion. Joining us now to discuss is J.P. Morgan's Bob Michael here in studio, and PGIM's Tom Porcelli. And I'm curious, Bob, from your vantage point, how much are we solidifying on a narrative versus still running around like chickens with our heads cut off?
I think we're pretty close to a narrative right now. Certainly since the end of March, we've seen pretty much a seventh-month straight sell-off in the bond market, yields going up very, very high. It seems as though we're reaching a point in the cycle where we're going to establish a range. And maybe the low is somewhere around 430, which was the high from a year ago, last October. And we've seen that 5% brings in buyers. I would say after 7 months of the kind of volatility we've seen, we're due for a range.
All right. So do you agree, Tom? Have we solidified on a narrative?
Yeah, I love that the way you phrased that, as you always do. Yeah, look, I think that it's. I don't know if we totally solidified on a narrative, particularly as it relates to the economic backdrop. I mean, a lot of people I speak to, I think, are still sort of in these two distinct camps. Either you're looking for no recession or you're looking for a recession. In fact, I would say there are fewer people looking for the latter. I think the risk of recession is actually quite elevated. We officially pin it at 25%, which, if you consider the steady state is around 12, you sort of 2x what it would normally be in a steady state backdrop. I think that there are a couple of things that really continue to worry me. I think yesterday's ECI report, just as an example, to me, that's sort of an ugly dynamic. Not so much because of what's happening from a wage perspective, because wages continue to slow down. But if you look at companies' abilities to pass on these prices, which are growing incredibly limited, right, relative to, if you just look at the CPI as an example, you have a situation where wages, while they're coming down, are still elevated relative to companies' ability to pass on cost. I mean, that tends not to end well from a labor market perspective. And I think there's other data, Lisa, that have been pretty consistent with that. I think the rise in continuing claims, I think, is really pointing to weakness in labor. So I think people will start to sort of gravitate toward this idea, but it's taking a little bit of time economically anyway.
What do you think of that, Bob? I mean, I know that you've been talking about weakness in the market, and you are expecting recession this quarter, in the fourth quarter, rather. That's been pushed out. Where do you see it? Is it really an indicator that other people are seeing as strong?
I think Jay Powell and the Fed have every right to come out today and say, we told you so. We're in a soft landing. We've got full employment and inflation has moderated. If you look at the 3-month and 6-month annualized rate of core PCE, it's 2.5 and 2.8%. We're there. I guess the question is, the trajectory is down. How do you flatten it out from here? And I think that's the big question ahead. But for sure, I would have thought we would have seen more widespread signals of recession. and we haven't.
Well, but hold on a second. And Bob, I'd have to really dig into that a little bit more. If Jay Powell came out today and said, "I told you so," everyone's screens would light up. People would say they're overly complacent. They don't understand the risk of reinflation. They don't understand that this underlying strength, as you were talking about, Bob, is going to continue. Why don't you agree with that? Why don't you say, you know what, we are seeing unexpected strength. This does lead to a potential need to keep rates higher for longer?
I said he had every right to, but he's also very, very smart, and that's exactly what he doesn't want. He doesn't want to accidentally ease financial conditions. He needs to buy some time, a couple more quarters, to see the impact of the long and variable lags, and they're there. We've seen the ADP data today. We're seeing some slowdown in the labor market. We're seeing some pressure in the levered loan market. So there are signals that the slowdown will continue. It's trying to engineer that landing that's going to be very challenging for them.
Tom, final thought?
Yeah, I actually agree with what Bob just said. I think the Fed actually probably could come out and say, hey, look, take a little victory lap. They're not going to, obviously. I mean, I think, because Lisa, you're quite right, too, in that if they did, I think the market would then immediately go to pricing in an outcome that the Fed does not want to see right now. So, look, we get it. I think today at this FOMC meeting, it's really about just sort of pushing the narratives that Powell has put out there, which is to say we've reserved the right to do more, but we want to sort of take a step back for the moment and see how this unfolds.
All right, well, let's get to some of the big news of the morning before getting your comments on that. The Treasury increasing its planned sales of longer-term securities by slightly less than expected. Exactly the news the bond market wanted to hear, and stocks for that matter. Bloomberg's Kayleigh Lyons joining us now in Washington with more. Kayleigh.
Yeah, Lisa, boosting it by $9 billion to a collective $112 billion. So slightly less than the $114 billion that the market was looking for. And as for what the breakdown is in auctions across the different maturities, $48 billion worth of 3-year notes, $40 billion of 10s, and $24 billion of 30s. The key point here, Lisa, being more of the burden is being put at the short end of the curve. The pace of increases there was the same as the last quarterly refunding back in August, but it's a slower pace of increases in sales of 10 and 30 years, likely a reflection of concern about the surge we have seen in those yields at the longer end of the curve. And some of that, though, is reversing today as a result of this news. We're off of the initial knee-jerk reaction, but still looking at about a 6 basis point decline in both the 10 and 30-year yield. The 30-year yield actually breaking briefly below 5%, now at 5.02, where we're at 4.87 on 10s, 4.89 right now on 3s. And finally, Lisa, as for the picture looking forward beyond this quarter, the Treasury says it likely will have one more quarterly bump in its quarterly refunding. So just a single additional increase in the borrowing here as they consider always ongoing the fiscal picture. And of course, what the Federal Reserve is going to do, both in terms of the rates, because that affects the cost of the Treasury borrowing, but also in terms of rolling off that balance sheet.
Thank you so much, Kayleigh Lyons in Washington, D.C. Still with us. We have Bob Michael and Tom Porcelli over at PGIM Fixed Income. Tom, what did you make of this announcement and the market's reaction, which was initially, wow, yes, they didn't increase their auction size as much, and then, well, they're still going to be increasing it.
Yeah, I mean, I think there was some relief. I mean, I think the risk was that it could have been worse. It could have been more. So I think that I get it, but I think what the market also needs to get is that, deficits for as far as the eye can see seem pretty reasonable. So even if the Treasury is not going to continue to increase their issuance, issuance is going to remain elevated, I think, for quite some time. I mean, I don't think you necessarily need to sort of, think of it in terms of, hey, there's going to be some big fiscal spend directed toward the consumer or anything along those lines. I think there's bipartisan support generally for defense spending, and you can easily see a scenario, given all that's going on, that really gets, I think, thrusted into the middle of this conversation. And so I think deficits remaining elevated for some time to come remain a very easy argument.
Which, Bob, is the reason why, I guess, maybe we didn't see as much of a boost to bond prices, yields lower, as some are expecting, including Mike Schumacher over at Wells Fargo. From your vantage point, is this telling that we didn't see a bigger pop in price in bonds in response to a positive surprise, at least, from the Treasury Department?
Look, after the last 7 months, we got somewhat of a pop. Think if it had gone the other way, who knows where yields would have been. The Treasury did exactly what you want your Treasury to do. They have a lot of funding to get out of the way for the government. They took feedback from the market. You had people like Josh Frost and Tom Tellis out there listening to the market was telling them, and the market was telling them front-end loaded. There's a ton of money in money market funds that can absorb supply there. And for us, we're seeing the greatest amount of inflows this year into the front end of the curve, ladders 1 to 5 years out. So we know there's money there to absorb it. The Treasury did a good job. That's calming the market.
So how much, Bob, are you doubling down, buying duration, coming into a market? Do you have confidence to do that despite the sentiment that you were just talking about?
Yeah, when we look at inflation, it continues to moderate across the board. And 5% seems to be a level that brings in an awful lot of investors that are trying to get into bonds and have underallocated to bonds for years. So we do like it here. I'd like to get past the employment number. I'd like to see what the Fed says today, but it looks as though we're going to be in a range for a while.
Tom, how important is that labor report that Bob mentioned coming out on Friday?
Yeah, I mean, look, it's always important, but that's a for better for worse idea, just to be clear. Look, I think, continued moderation in the labor backdrop, even if it's uneven, I think is going to persist. We've been really flagging to people. I think you really need to strip out healthcare from the headline number. Healthcare has been doing a disproportionate share of the driving. And when you do that, what you see is that the job gains have indeed slowed and slowed pretty considerably. So there's something we expect will continue. And again, I would just flip back to the thing I started off with. It's just watch. The more that you have wages that remain north of companies' abilities to pass on prices, that will not end well from a labor market perspective. That's the real risk.
Although I will push back a little bit on that, Tom. I mean, some of the companies that have come out, whether it's McDonald's, whether it's Caterpillar, whether it's a whole host of others that have shown that both volumes and prices increased, suggest that maybe they are passing it along.
Yeah, so I think you're quite right, Lisa, and we see that pretty clearly in some of the earnings reports. But in the aggregate, that's not the case, right? In the aggregate, you actually are seeing this slowdown persist. Some companies, for idiosyncratic reasons, can certainly be able to pass on those prices. But in the aggregate, we're seeing that that's now fading.
Bob, given this backdrop, is this supportive for corporations, for corporate credit at a time where maybe 5% is where it draws in investors, but it's unclear whether the yield on the 10-year can go that much lower and financing costs are going to be higher for a longer period of time?
It depends which corporate credit. And I think we've seen plenty that the public markets have the big liquid companies that can access a lot of funding, and they termed out their debt. So the public investment grade and high yield markets aren't what they were in previous cycles. You have to look at the levered loan market. You have to look at the private credit market. Each of those markets is equal in size to the high yield market. That's where you're going to see the pressure. That's where the floating rate nature of those markets is going to create pressure as they refinance at much, much higher rates. You also have to look at banks. You have to look at C&I loans, commercial and industrial loans. A lot of those loans were put on a couple years ago at 5%, and they're rolling over at 10 to 12%. That's a lot of pressure on corporate America that no longer really resides in the public credit markets.
And a lot of people are watching some of those metrics more and more. Bob Michael, Tom Porcelli, so glad to say that both of you are sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle.
Well, the S&P 500 right now, Lisa, as you've been noting, has turned slightly positive, basically flat. But beneath the surface, lots of big movers, including the shares of CVS, which are down. This as the company did, in fact, beat third quarter estimates, both top and bottom line. But they've tempered their full year view, their strategy of moving more into healthcare, not paying off quite yet, at least relative to profits. Plus, pharmacists are planning a walkout. This stock already down 26% year to date. Estee Lauder plunging down 17%, heading toward what could be the worst day since May. It might even be before that at this point. Their fiscal year sales are now expecting a range of down 2% to up 1%. Disappointing. This on China weakness. Geopolitical risks also weighing on demand for premium beauty. This stock down 48% into today's plunge. And then finally, AMD in the aftermarket yesterday down about 5%. Just moments ago, it had been higher, now down just a little bit. What folks are not liking, their fourth quarter sales view is 5% below the midpoint on weak video game demand. On the other hand, what's recovered the stock to some degree off those 5% lows yesterday, Lisa, is that they've talked about a new AI chip that could be worth $2 billion in net sales next year. This stock up a mere 52% year to date when you compare it to NVIDIA, the AI leader, up about 179% this year.
Abigail, thank you so much. Coming up, counting down to a Fed rate decision.
I don't think it'll be an uninteresting meeting or press conference. It's just really a question of how far Powell wants to go down the road and try and sort of reassure markets.
Trying to justify why to pay attention to a meeting that everyone says is basically a placeholder. A Fed rate decision coming at 2 p.m. Eastern. That's when surprises happen, followed by Chair Powell's news conference. We've got your Decision Day watch list coming up next.
I don't think it'll be an uninteresting meeting or press conference. It's just really a question of how far Powell wants to go down the road and try and sort of reassure markets. To what extent did the Fed really anticipate or understand that their actions at the September meeting was going to lead to this sort of near 100 basis point sell-off in the long end? I mean, it's been quite dramatic, and did they really expect that?
All eyes on the FOMC decision coming at 2 p.m. Eastern. Chair Powell set to speak just 30 minutes later. The Fed expected to hold rates steady. Bloomberg Economics saying officials will likely maintain their tightening bias. So a hawkish pause. Powell is also expected to address the recent surge in longer-term Treasury yields, saying they could, on the margin, substitute for 1 or 2 rate hikes. Bloomberg's Michael McKee joining us now from Washington, D.C. So is this just a placeholder, as Subhadra Rajappa put it yesterday?
Well, if I were to agree with her, the producers of the afternoon shows would all be mad at me. So let me just turn to the Fed funds futures market and show you just how excited the markets are by this afternoon's meeting. Well, okay, maybe not. No chance at all is forecast basically for any kind of Fed move. How come? Well, one reason it's going to be, as Dominic Consum says, boring, is that there are no dot plots and there is no new economic projections coming out today. The Fed obviously not going to raise rates, but Jay Powell has some splaining to do. Could make the news conference interesting. We've got 4.9% GDP, 3.8% unemployment. We've seen wages rise. How come the Fed isn't going to be moving? Well, here's their argument. The Fed doesn't have to move because the markets did. And you can see there the way that the 10-year note yield has risen, and Dominic was talking about that. And that's pulled financial conditions higher. The blue line is the Goldman Sachs Financial Conditions Index. The white line, though, that's the Fed's own financial conditions index. It's only out monthly, but it shows that financial conditions peaked in December and have been getting looser since then. So we'll see if Jay Powell can square that circle. And, of course, it's now time for Bob Michael to tell me what I'm supposed to ask him.
Bob Michael McKee, thank you so much. We do have special coverage of the Fed kicking off at 1:30 p.m. with a whole host of great guests, including former Fed Vice Chair Rich Clarida and former New York Fed President Bill Dudley. So let's get that. Bob, what's your question?
Yeah, Mike, so much to ask today, but I think what you ought to do is go right at the nature of the recovery, which has evolved into a K-shape. Or put differently, the bottom quintile of earners, the younger cohort, they're the ones who have depleted their excess savings. They're the ones who have ramped up their credit card borrowing to try to make ends meet. They're the ones that don't sit on assets that have inflated. And if you look at the top quintile of earners, the older cohort, they're the ones that have all the excess savings. They're the ones that are sitting on houses and securities portfolios that are at elevated levels. What does the Fed think about that, and what are they doing about that? Because if you go back to the Fed Listens Tour of 2019, of 2019 and 2020, they specifically addressed this and talked about how Fed policy has to be inclusive. And it's evolving into something that is clearly not inclusive.
What about the young people? Tom, what's your question?
Yeah, I was just pondering that question. I ponder it ahead of every meeting. Look, I think, I don't know if it matters what you ask him. I think you tend to get an unsatisfying answer. I mean, I'm sympathetic to Mike and all of the other reporters and journalists down there because I don't know that he can really. Powell's going to be the last one to say, hey, look, we're changing policy, right? I mean, he's going to stick with his narrative. I think until the bitter end, and then one day he'll say, "Okay, we're gonna, we're thinking about cutting rates now." So I'm sympathetic to Mike and the rest of the crew down there. Look, I think at the end of the day, I think the challenge for me is I think Powell has. I give him a lot of credit. I think he's done a really good job, particularly over the last couple of meetings, of really sort of sticking with this idea of, look, we really want to sort of take a more wait-and-see approach, let our eyes, I mean, I think that was the exact word that he used during his last speech, let our eyes sort of, judge what's happening with a bit of risk management layered into that. I think that's quite the right response, and so I'm looking for more of that at this meeting.
I love it. That's one thing that Steve Englander said. How many times can you say, we'll see? Bob, is this essentially a meeting that is going to be like watching paint dry, like supposedly the balance sheet rundown that arguably is having a significant impact?
No, and I think you're in the room, you ask the questions, the Fed and their staff can't unhear the questions. So they go back and they work on it and they go out into the market. So I certainly wouldn't pass on the opportunity to ask a question. It's your chance to register issues, so do it, Mike. I don't think this is like paint drying. I think these FOMC meetings, these are like playoff games. We want to see what's going on. We want to be part of them. We want to know what the Fed is thinking. We want to know how they're responding to things. And the markets do move.
That's fantastic. That's a great way to really put forward the Fed decision later. It's like a playoff game. Bob Michael, Tom Porcelli, both of you, thank you so much for fantastic insight ahead of a meeting that is telling. How many times can you say, we'll see? Coming up, the morning calls, and later, BlackRock's Kate Moore expecting stocks to slowly overcome a volatile few months ahead. That conversation still to come. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Let's take a quick look at markets. You are seeing a bit of a churn after better than expected, at least, refunding agreements. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Goldman Sachs adding Boeing to its conviction buy list, pointing to strengthening fundamentals and an attractive buying opportunity. Next up, Loop Capital upgrading Cirrus Logic to buy, expecting upcoming results to benefit from a host of new Apple products. And finally, Barclays upgrading GM to overweight, citing historically cheap valuations. Coming up, we get the word from BlackRock's Kate Moore. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Just moments away from the start of trading at a time where you do see bonds controlling everything. Stocks are in the green as we head toward open. S&P futures up 0.2%, about the same as NASDAQ, given the fact that we did get a refunding agreement from the Treasury Department that underwhelmed. The action has been driven by what's outside of stocks. That is what's in bonds. That's in what the bid is to the long end after the Treasury avoided raising some of those auction sizes as much as some people expected. You could see 10-year yields lower off some of the earlier lows, 4.87% rounded up. You could see that being borne out, dollar strength pretty much across the board. This has been throughout the morning, and crude elevated up to 2.4% on the heels of just that ongoing geopolitical and humanitarian disaster. One stock to watch at the open, WeWork, the company reportedly planning to file for bankruptcy as early as next week. This, according to the Wall Street Journal. Bloomberg's Abigail Doolittle has more. Abby?
And the stock is absolutely plunging, as you can see, Lisa, down nearly 44%. The worst day in its young life. This company, of course, went public back in 2020. And that's saying something given the the dozens of double-digit down days this year. Into today, the stock already down 99% from that price back in 2020. And of course, today's plunge is spurred by this Wall Street Journal report that the company is preparing to file bankruptcy. In some ways, you could say it's a victim of its own success. They expanded so quickly in the years ahead of their going public. And then, of course, there was the secular shift off of the pandemic, working from home, the less demand for their office space that they were renting, creating fewer flexible tenants. Now, the company missed interest payments back on October 2nd. That kicks off a 30-day grace period. Missing the payment would be considered a default. WeWork declined to comment on what the company called speculation, and yet went on to say that there's a forbearance agreement in those bonds that allows them to have positive conversations to try to work it out. Again, Lisa, this stock down already 99% into this year. It's interesting, though. There's 777 locations across the company. It's going to be very interesting to see how they, of course, do work this out. They're running out of time. Going concern risk is clearly a big one.
Agreed, Abby, especially with all the concerns around real estate. Turning now to the chip sector, AMD falling after delivering a weaker than expected revenue forecast. The CFO saying, quote, "We expect to see strong growth and continued momentum, partially offset by the softening of demand." Bloomberg's Ed Ludlow joining us from San Francisco with more. Ed?
Yeah, good morning, Lisa. The stock is up a full 2.8%, which, believe it or not, is AMD's first back-to-back two-day or multi-day gain in a month. It's completely at odds with the trading that we saw in after hours following the earnings call yesterday, and completely at odds with pre-market trading. The story is the MI300. It is AMD's AI accelerator, akin to NVIDIA's H100 GPU, which is used to train large language models or foundation models. The news is that it will go into production and ship by the end of the year, but the rate at which it will show up as substantive revenue is really what the market's trading on here. Full year 24, Lisa Su, the CEO of AMD, expecting $2 billion of sales for the MI300. The expectation is that in the current period, it could be $400 million worth of sales, and AMD believes this will be its fastest ever product to reach $1 billion in sales. What was disappointing to the market during earnings was the forecast for the current period. The midpoint of the range that they gave, $5.8 to $6.4 billion, was below the consensus forecast. While the street acknowledges, in terms of sell-side notes this morning, that its data center business is in the early innings. It's going to be a while until we see those big numbers from the AI accelerator. The overall data center business is stagnating, and the commentary and guidance we got is that gaming will be a point of weakness. And remember, AMD's origins are in GPUs for gaming. So it's not all perfect, but right now, the stock heading towards a 3% gain, and the market is got what it wants in terms of hearing about this MI300 AI accelerator.
Ed, thank you so much. Turning now to consumers and beauty products. Estee Lauder falling to its lowest level since 2017 after cutting its full-year outlook due to what they said was continuing weakness in Asia. The CEO saying, quote, "We're accelerating and expanding our profit recovery plan to rebuild profitability despite the external pressures on the business." Just how much it is with respect to China. And they also mentioned Israel. Joining us now, Bloomberg's Isabel Lee.
Hi, Lisa. So that's lowest since 2017, you're right, and that's 6 years. And if this current pace holds, the company will be shedding around $7 billion in market cap. So the company cut its annual sales and adjusted EPS forecast, and it's really due to three things. First, it's the pressures in Asia travel business. Second, it's a slower recovery in China. As we all know, we didn't see the pandemic boom that we were hoping, especially in the beauty sector. And lastly is, to your point, the disruption in the Middle East and, of course, in other parts of Israel. So diving into earnings, Estee Lauder expects net sales in a range of a decrease of 2% to an increase of 1% year over year, and earnings of $2.08 to 2.35 cents a share. So overall, a Bernstein analyst said this is an ugly set of numbers, and the Jefferies analyst said they're expecting the stock to re-rate as the recovery timeline is pushed out. And Estee Lauder's quarterly earnings are actually a contrast to its rival like L'Oreal, which saw sales up around 4.5%. And now, Lisa, you see the stock is even really tumbling to more than 18% at this point.
As you speak, Isabel, thank you so much. And sticking with earnings, share of Norwegian Cruise under pressure after slashing its full-year earnings forecast. The CEO saying, quote, "While we're keeping a close eye on rapidly evolving macroeconomic and geopolitical events, we remain encouraged by our strengthening bookings position," trying to put a sheen on it. Katie Greifeld has more. Katie.
Well, Lisa, Norwegian Cruise has the unlucky distinction of being the first U.S. major cruise operator to lower its guidance this season. Of course, you're actually seeing the shares bounce around. We're going to get to that. But just to go through the numbers here, the cruise line now sees adjusted earnings at 73 cents per share this year. That's down from its prior outlook of 80 cents and below the average analyst estimate of 78 cents. But outside of that, the quarter was actually pretty good. The company beat on earnings. Sales were in line with estimates. And the company also said that demand for trips to Maui is rebounding following the fallout from wildfires in that region. And just for some context, about 6% of its capacity typically stops in Maui in the fourth quarter. So that's good news there. And you can see those different cross currents playing out in the shares right now. Of course, Norwegian fell about 7% pre-market after that outlook cut. Now higher by about 2.5% or so. But zooming out, Norwegian only about 10% higher in 2023. That is lagging Carnival, Royal Caribbean in a big way. And I'll just add, both of those companies actually increased their outlook recently. So Norwegian, the odd man out.
Katie, thank you so much. Hard to come up with those macro stories based on some of the travel names. Stocks coming off their worst October in 3 years, forcing a number of strategists to cut their outlooks. Wall Street's biggest bull, the latest to cave, Oppenheimer slashing its street high target of 4,900 down to 4,400, about where it had been earlier in the year, citing souring sentiment amongst traders just simply running out of time. Ed Yardeni also sounding the alarm, writing, quote, "We still think a Santa Claus rally is possible, but between now and Thanksgiving, it's easier to see downside than upside for the stock market, given the unsettling developments in the Middle East and jitterness in the bond market." Let's continue the conversation now. I'm so pleased to say with BlackRock's Kate Moore. Do you agree, Kate, that even if the fundamentals paint a picture that could be positive for stocks, sentiment just won't allow it?
Yeah, sentiment is really, really low right now. And actually, I was looking for earnings season to really encourage investors to get back into the market, even if it was more around idiosyncratic stories than broad market exposure. But there's been very little coming out of CEO and CFO mouths that have encouraged the investors to put cash to work. And I think this is because the macro uncertainty is incredibly high. People have no idea, frankly, what 2024 is going to look like from an inflation, from a labor market, geopolitics, political dysfunction standpoint. And so, the commentary has been very soft from management teams, and that has led to downward pressure further on sentiment. So I was hopeful, Lisa, at the start of reporting, we were going to get an increase in enthusiasm, and it's just failed to materialize.
Which raises this question, and the bulls in the street will say that this actually sets you up for a rally. Maybe it's not going to happen in the next month, maybe not in the next 2 months, but at some point, just because things are so depressed that people are looking past any beats, any positive signs within corporate balance sheets.
Yeah, I have to agree with that. And look, sentiment had been deteriorating for a while, and this is kind of another important leg down. But of course, in order for reversal, and even if it's just more technically driven, there has to be some sort of positive catalyst, whether that comes from policy guidance or from the labor market, which I think is going to be a key thing that investors across asset classes are going to be watching, is left to be seen. But I absolutely agree. Whenever you have this level of bearish sentiment and you see all these sell-side strategists cutting their forecasts into year end, that sets up for a bit of a rally. How long-lived that's going to be, I think, is up for debate. And I think you're going to have to be really tactical around trading it over the next 2 months.
Some people would take the bearish side of it. JP Morgan's Marco Kalanovic among them, seeing earnings estimates, quote, divorced from the risks posed by tightening financial conditions and rising geopolitical tensions, writing, absent preemptive rate cuts by global central banks, we see risks compounding with peak effect of restrictive monetary policy still ahead. Kate, from that vantage point, right, on one hand, there's a geopolitical overhang. On one hand, there is sort of just general angst and concern. On another level, we have a profoundly different financing conditions, given how high benchmark yields are. And, even based on what we saw this morning, sure, you could get some rallies, but they're not going to be that significant given what people expect from the U.S. economy.
Yeah, I think there are two ways to respond to that view. I mean, the first and most importantly is that there have already been rolling recessions across industries in terms of earnings in the U.S. economy. You saw, bank earnings and healthcare earnings driven by pharma, materials. Now you're getting energy and autos, for example. Semiconductors have been depressed. You've seen this weakness in the U.S. and the global economy as a result of higher policy rates. So just because aggregate economic data hasn't shown that, or aggregate earnings haven't been as bad as in previous earnings recessions, I think we need to recognize that some pain has already been felt and some adjustment has already happened. The second part of it is, of course, there's this huge differential, and I know we've talked about this before, between the large cap and the small cap side in terms of dependency on debt, how expenses and spending are financed. I think it's really important to recognize that for most of us that are large cap or mega cap type investors, there is very little floating rate debt, and most of the spending is being financed from free cash. So it's a very different story at the index level versus at the small business side. And the small business, while being important from the labor market perspective, is not necessarily going to drive the stock market.
So what I'm hearing from you is it that the long end of the Treasury curve is too volatile to even play with, just ignore, go in the front end, clip your 5% coupon, go into big tech and call it a day?
I would say outside of big tech, there are also some pretty interesting opportunities across cyclicals emerging. I mentioned kind of the rolling industry earnings recessions, and I think there are some interesting values being presented across resources and across more cyclical parts of the economy.
How much within the bond market is that sort of the dominant idea, that there has just been too much volatility, too much uncertainty about what's driving the incredible volatility in the long end to get involved? Is that how you guys feel?
I think volatility in general has been weighing on investors. There's a long expectation that volatility was too low, we were kind of missing something, and now that volatility has moved back up, or at least measured volatility and expected volatility towards levels that are more commensurate with long-term averages, there is a sense that perhaps we need to be more cautious. And again, taken that with the macro uncertainty we've talked about, the softer guidance we've gotten from companies, and the fact that there's a lot of policy decision yet to be made, to not just today, but also through year end. I think you take all this together and people really do want to be more cautious in terms of their risk taking, which presents itself both on the bond side as well as on the equity beta side.
Kate, it strikes me, and I'm kind of thinking through this in real time, so bear with me, that it seems like while the bond market was suppressed completely by 0% rates for however many decades, or at least for more than a decade, that the market structure changed. And suddenly, now that we have yields and volatility, we have leveraged players getting into the Treasury market in a way that we hadn't before. How much is that really what's whipping things around at a disproportionate pace?
Yeah. Look, here's what I'll say. I'm less an expert on the technicals within the bond market and the players in different parts of the curve. But one of the things I am very aware of is the calculation that equity investors are making when deciding whether or not to take equity risk. And we haven't had the same type of calculation since before the financial crisis, where, the cash yield is really creating, huge competition for overall equity risk. And now analysts have to say, okay, I like this stock, I think we can move, but can you move, 5.5% plus some, considerable equity risk premium in the holding period in which we're going to own that stock? And so I think the calculation is different. Investors who've gotten very comfortable with one way of analysis over the last 10 to 15 years are having to change their models. And I think that's going to lead to some pretty interesting opportunities next year, albeit more idiosyncratic than just broad market.
So in other words, you think that there are a couple of shoes to drop?
Perhaps.
Kate,
but I'm not bearish, Lisa. I'm not totally bearish.
You're not being bearish.
I'm more cautious. Yeah, I'm more cautious than I've been.
There could be a couple of casualties, maybe, to some of the fragilities that we're talking about. Kate Moore, thank you so much for taking the time. It's always wonderful to speak with you. Coming up, House Republicans struggling to gain support for their Israel aid bill.
Demanding offsets for core national security needs like supporting Israel and defending Ukraine is a break with the normal bipartisan process that could have devastating implications for our safety and for our national security interest overseas.
That conversation coming up next.
I think we've been very clear. Saw it in Crane's statement last night, how deeply concerning this House Republican bill is, and how it doesn't meet our national security needs. Demanding offsets for core national security needs like supporting Israel and defending Ukraine is a break with the normal bipartisan process that could have devastating implications for our safety and for our national security interest overseas. There shouldn't be any political games played here with our national security or trying to turn support for Israel's self-defense into some sort of political football.
Secretary of State Antony Blinken returning to Israel Friday, reiterating U.S. support as fighting continues. This as the White House warns Biden could veto the GOP's Israel-only aid bill, which demands IRS funding cuts and excludes aid for Ukraine. The administration saying the bill, quote, fails to meet the urgency of the moment by deepening our divides and severely eroding historical bipartisan support for Israel's security. This bill is bad for Israel, for the Middle East region, and for our own national security. Let's get to our team coverage right now. Bloomberg's Oliver Crook in Tel Aviv and Emery Herdern in Washington, D.C. Emery, I want to start with you. Just how contentious is this issue about getting some aid through?
Well, it's very contentious given the fact that we heard from the White House yesterday saying that the president will veto this bill, this standalone Israel bill that House Republicans are looking to pass this week. So it's one, contentious with the White House. In this statement, the White House talked about that they're making an ally as Israel in the world a political pawn in this debate, and that it sets a very dangerous precedent when it comes to wanting to secure partners and allies around the world. That's the first hurdle. The second is the fact that you're actually going to see Mike Johnson, the Speaker of the House, come up against Senate Minority Leader Mitch McConnell, who wants to see a bigger, broader package. So there's going to be not just confrontation between House Republicans in the White House, but also House Republicans and other Republicans in the Senate.
Meanwhile, Oliver, there's a real question about what's going on in terms of the strategy of the Israeli army, about how they are planning to continue what they're doing in Gaza at the same time that there are some fronts that are getting increasingly active outside of that area. Alia, what's the clarity that we're getting in terms of scale and scope of what's going on the ground?
So let's focus first with outside of Gaza. And, again, there's been continued firing back and forth on the northern border with Lebanon. I think the Syrian side has gotten a little bit more quiet, but that's another one to watch. And, of course, now paying a lot more attention to Yemen and some of the missiles that are going up the Red Sea and some crossing even over Saudi Arabia. So those are the other ones. But again, the main action, the main focus right now is on the ground offensive that is going on within Gaza. There is not a great deal of transparency from the IDF in terms of what their movements are. We understand that the troop movements seem to be encircling Gaza City. And of course, one of the main focuses overnight was the striking of this refugee camp, which killed at least dozens of people. It's not clear how many of those people were part of Hamas. A number of them at least were, says the IDF. But again, this is a densely populated area, and it's not clear how many people had already evacuated. So the pressure is continuing to mount here. And again, we see that the Israelis themselves have also lost, they say, their 11 soldiers since they entered into Gaza over the weekend.
Do we have any sense, Emery, just quickly here, of who else Tony Blinken plans to meet with in the region aside from Israel?
At the moment, we only know that he's going to Israel. He also is going to be touring the region, as you mentioned, Lisa. They have not released the names. Likely, potentially, you can see him go to Jordan and meet with King Abdullah. The President Biden had a call yesterday with the Jordanians, also potentially President Sisi of Egypt. Egypt is critical at this moment, especially given the fact that Tony Blinken said yesterday up on the Hill that there are about 400 Americans, and including their family, that means about 1,000 that are stuck in Gaza. And we know at this moment, it's not looking like those American nationals are getting out.
Oliver and Marie, both of you, thank you so much for being with us. Meanwhile, fresh PMI data crossing the terminal. Let's get straight to Michael McKee.
Lisa, you and I have been talking all day about this indicator or that indicator being boring. You want boring. The S&P Global Manufacturing PMI just out. Last month was 50. The forecast was 50, and it comes in at 50. So absolutely no change in the PMI outlook on the S&P side. Now, at the top of the hour, we get ISM, and that's the one that the market really pays attention to. we could have something similar happen because last month was 49 and the forecast is for 49. If we get 49, we'll know there's a manufacturing conspiracy out there. Other thing we'll watch at ISM is the prices paid index, supposed to go up just a little bit. That would not be something that the Fed would look too kindly on, even if it may be still temporary.
Mike, thank you so much. Meanwhile, we do see the rally in 10-year treasuries in particular continue, with yields now down about 10 basis points from the highs earlier overnight. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. For the Trading Diary, you need to be watching this week. JOLTS data coming out at the top of the hour, as well as, of course, ISM manufacturing data, and FOMC rate decision coming out at 2 p.m. Eastern, followed by Chair Powell's news conference Thursday. More data, including jobless claims and durable goods, plus Apple reports earnings. We haven't even talked about that today. And we'll get a decision from the Bank of England. And finally, on Friday, the big jobs report, the October non-farm payrolls report, and our special coverage of Fed Decides kicking off at 1:30 p.m. Eastern, speaking with former Fed Vice Chair Rich Clarida, as well as many, many more. This is Bloomberg.